indicators. So let's get down to the trades. So Jared asked me to focus a lot on the short-term trades, and last time we looked at the long-term setups, and they are still important. I determine context by looking at the long-term trades, but I trade every day using 1 minute, 5 minutes, and hourly charts for swing trading. So this first example, we've got a 5-minute E-mini gapping up, and with our trend up, you'll be looking to fade on the 1 minute, looking for support. So this is a very quick ABC agreement move down into support. So you'll be, or what I did was I tried to buy down here. I had an order in, I got filled. The stop below the lower level, below the XOP agreement down here. And looking at that, there you can see the market getting down to the support. And calculating our expansions to take profit, we've got one ABC up. You can already see the market pulled back from the COP. And then the next level will be the OP. Another ABC forming with the new reaction, a new COP, OP, and XOP with such a strong gap. I would expect the market to at least take out the highs, and with some stops building here, I was aiming for the higher level at 1943. The market moved up swiftly into that level before pulling back. So that's just one trade showing you how the market actually respects these levels even on a 1 minute chart. So I like to actually trade the S&P as well as oil. I look at Euro stocks during European hours on 1 and 5 minutes, and then I also look at our local South African stock index on 3 and 5 minutes. The 1 minute is a little bit too quick. It's not as liquid, so the 3 minute is as slow as I would go on that one.
Peter, can you go back to Peter? Can you go back to the original slide? I want to clarify something on that trade.
This one, Joe, or the first one?
The first slide on this trade.
Okay, there you go.
Okay. Now your buy point was exactly where?
Down at the first agreement, down at 1938.
Okay. Now that wasn't the agreement level that you showed earlier, where you have an ABC coming into a fib node, a support node. The ABC down is actually a support area because the ABC down is your profit objective for if you were short. So you're actually buying on the ABC down. So
that's right.
That is a support point, and that is in agreement with a fib node, and that gives you your number. Is that correct, Peter?
That's right. Yeah, that's correct.
All right. Now, the point that I really want to clarify is that on a strong up move, which you see on the left-hand side, the trend is obviously up, and everybody wants to be a buyer. Now, something has to happen in order to get some sellers into the market and in order to get you filled, because the way we trade is we buy pullbacks in an uptrend. We sell rallies in a downtrend. So what is going to happen that allows you to get long? And that's what Peter said when he said you fade the 1 minute. Now, if you look at the chart on the right, yeah, that is actually a sell signal. So what we do is we fade the sell signal. Fade means to go against. If this were a daily chart, we could fade the 30-minute sell signal. If this were a monthly chart, we could fade the daily sell signal in order to position ourselves in an ongoing uptrend. So we actually use sell signals to position ourselves. Now, I did a presentation with Jake Bernstein, must have been 1987. And Jake had just taught them the stochastic and indicated how it was a trend indicator and how terrific the stochastic was. And in class I said, yeah, and you can use this stochastic in order to position yourself. So when you get a sell signal in the stochastics, you're a buyer. Well, everybody in the whole place went crazy because, you know, Jake had just taught them that you follow the trend of the stochastic, meaning that if the stochastic is indicating up, you just buy it. Well, in this case, we are using the MACD predictor, which we have the number ahead of time. Remember, it's a leading indicator. We're using that in order to enable us to get filled exactly where we want to be filled. And we know where we want to be filled because we have the tenacity levels to tell us. Go ahead, Peter.
Yeah, That's right. So fading the 1 minute against the 5, that's what Joe's talking about. So I always wait for a lower time frame to go into a sell if I want to buy. You want to have someone that's selling the market that's going to be wrong to take their position and get out at a profit. So let's go on to the next example. You can see copper. In this case, the weekly was down. So it's a little bit of a longer term setup, but I actually traded it on a 5 minute eventually. So we had a weekly sell signal, and then our daily came into this big agreement resistance zone down just beneath 214. I actually didn't sell it there. I wasn't at the market. So I think I was away for a couple of days. So I didn't get an entry. And when I saw this big down move, I dropped my time frame to try and get short the market. So let me show you what I did. I dropped to the 60 minute. So this is the 60 minute chart showing that big down move from 214.50. So that's the high that formed over here on this day. And you can see the multiple reaction points showing a wideish confluence zone between 208.30 and 208.80. So that was the level that got me interested. And the market came real close to that at 208.15. I didn't get a fill yet because I was waiting for the 208.30. I didn't get sucked into the move. If I don't get filled at my level, I don't do the trade. So that's one thing. You need to have patience with these types of things and wait for the correct setup. The ABC formed, which gave me even stronger resistance. So now we've got confluence agreement. I got my fill, and the market almost within the next hour started to collapse. One other thing I noticed was all of these lows. Now, for those of you who've been trading for a while, you probably know what's sitting down there, and that stops. A lot of people has got their stops. They've been buying the market, or they want to initiate new short positions on the breakout. So there's going to be a lot of selling down there, and the big guys know about it. The institutions push the market down to those stops. They sell it, and once the stops get triggered, they just clear their trade. So I was anticipating a move down to those stops due to these big moves down. And you can see the 5 minute. So I was looking at the 5 minute as well, seeing if I can find more resistance. So the market's stopping just shy of that 204 level and the stops, forming a new ABC and another wideish confluence agreement zone. I had an entry there, and then I had to calculate my exit. So I was thinking OPs usually are good profit targets, but in this case it was exactly where all the selling was going to be. Now I seldom go for the XOP, which is our expanded objective point. Usually the market gives you the OP, well, usually it gives the COP. Most of the time it gives the OP, but seldom you get the XOP. In this case I aimed for the XOP with good reason, with the stops triggering. It slammed us actually right through those XOPs and finally settled down on the hourly OP. Now you remember selling it up at the 208.50 level, selling it once again around the 205, anticipating the stops triggered, getting out down at the 203 level with the market actually pushing a little bit through that down to the lower OP support. So that's a nice little swing trade, and we'll be discussing the usefulness of these tools. As you can see, I'm watching different markets, and these tools adjust to how the markets develop automatically, because the retracements will jump as the market makes new highs and lows. So I'll show that a little bit later. Just another trade on the Euro Stock 50. We had a daily sell, which actually didn't have.
Peter, can I interrupt you
Joe?
just a second? Yeah, for the newer people here, you know, I've done a lot of teaching. For the newer people here, there's something that they really need to get in their head so that they see really the tremendous advantage we have over other traders. Can you go back about 3 slides? It's just something I want to point out.
The one with the stops?
I'll let you know when you get there, because
This one?
No, before that. Just back it up again.
This one?
Okay, yeah, that's the one I wanted to show you. Now you see that confluence, that was an agreement area, and actually it was an agreement confluence, correct?
Yeah,
Here?
that's right.
Okay, now the thing that people need to understand is you see that C point down there, 220550? All right, now what you really need to understand is this is when we get the number. I mean, what is this? This is a 60-minute chart, so
Yeah, it was actually down here. I can show that down at 205.50.
Exactly. See, we get that number way ahead of time. We know where the resistance is ahead of time. Now, what happens in the real world is we've now got all these computer algorithms, and the computer algorithms don't know where these numbers are. They don't. They truly do not. So what happens is that when the market heads up there, and people like myself and Peter and other people, some very, very large funds, people that I've taught, very large traders, they get in there and they start selling. What happens is the algos pick that up. There's no way you can sell this market without the algos knowing what you're doing. So they go, oh wow, they're selling here, and they pile on. Well, we know where the algos are going to act before the algos do. And that is absolutely critically important when you're dealing with something like the E-mini, or in this case, copper. Go ahead, Peter.
Yeah, that's right. And I think that's exactly what happened here. When the market came into that resistance zone, it picked up the selling, and hence the big move down once again. So let me get back to the Euro Stock 50. So I look at Europe as well. That's more my type of hours. I usually trade the E-mini opening, and copper I trade because the London hours, the traders still move copper around quite nicely during my day hours. So that's good for me. The Euro Stock 50 had a sell. The market was below our trend indicator. Just quickly, I saw a quick question, so maybe I can explain that now. This predictor indicator is the MACD predictor. So it shows us on the chart where the MACD turns. And a lot of folks use the MACD to determine trend. So we also use it to determine trend, but we're more interested in seeing how the market reacts on these crossing values. That's why we've got a crossing value. You can see two in the axis over here on the NinjaTrader. Let me maybe go back to a better example. Yeah, this one's not good. I'll mention it when I see one, but you can see two values over there, a red one and a blue one. The red one is the current bar crossing value for the MACD. That's where price goes through the MACD predictor over here. That's exactly the price level where the MACD indicator that the other traders use at the bottom will be turning up. It also tells me in the coming bar, so in the next bar, where's the price going to turn. So if I was short around these levels, the Euro Stock, I knew if price moved through these levels the next day, the trend's going to change. There's going to be buying in the market. And then I'm very interested in seeing if there is actually buying as the market moves through these levels or not. So in this case, the trend wasn't as good on the daily. It was down. And then we started to get some 60-minute selling and follow through. And looking at the 30, it was also in a sell. So I was interested to see how the market reacted at the opening on the Euro Stock the next day. It opened up at the blue line. We actually had a rally and then tried to rally on the buy, couldn't, and once we got the sell, we collapsed. And that's why I said I'm more interested in seeing how the market reacts on this. I'm not reacting on each and every buy and sell signal. Once I saw this, I knew, okay, there's some good selling. I'm going to try and get in on the first 1 minute buy. I want to sell the market once the 1 minute turns into a buy. So the 1 minute turns into a buy. I calculated a good confluence agreement once again. The market gave me a nice fill, and I calculated my ABC OP move down to calculate my profit objective, and within a couple of minutes I was out of the trade. Now you might wonder, why do you bother about a couple of ticks like this when you can catch the whole move? I'm more interested in the setup. This setup is such a high probability setup that I can do it in different markets all of the time, different time frames, and you'll be surprised at the probability and the accuracy of these types of setups. So once the 1 minute turned up, everybody was buying, and that's when I was selling. Just a quick question, stop above the next D level 3028. I usually give about 3 to 4 ticks above the level on the Euro stock. And actually, if the market broke this confluence agreement, I don't like that. If it breaks through that level, I would be looking to get out on a pullback from this higher resistance. So that's a disaster stop, would be above this 3028 level by a couple of ticks. I would be looking to use that level, a pullback from there to try and get out. So that's a trade on the Euro Stock 50 on the 1 minute chart. You're welcome to type questions as we go. We can answer them at the end. Another one was gold, a trade I did after the non-farm payrolls. So I wasn't in gold when the market did this rally. I was very interested in getting, no, I actually was long. I bought the market down here, but in a one lot. It was a small position because I knew the non-farm was coming up, and then we had the big rally. So I saw, okay, I see the cross on the daily, I see some buying, and I want to try and get long. Calculated the support nodes on the 60, so once again daily up. We're waiting for the 60 to turn down. I don't have the MACD predictor on here, but it was in a sell. Calculated support, and we've got a nice little agreement zone here. So it's not confluence, it's just agreement. Still good strong support though. The market came down to a tick of that big thrust F3. I actually had some orders in at the OP, so I got filled higher up. I really wanted to be aggressive to try and get in. I didn't get filled on the lower order, which was more down at the 1235 level, where the exact agreement level lied. But then with our 30-minute trend turning up after hitting the support, I once again applied the same concept. So I was looking to fade the 5. So the 5 minute goes into a sell. I want to buy. The daily's up. It's reacting from the support as I'm expecting. I'm using the 5 minute sell to get long. Once again, calculating a good support. Confluence agreement using the ABC down as well as our focus on 2 reaction points. And the market came to a tick, filling me. I calculated my profit objective, usually the OP, and it was near the closing bell for gold. My time, I think it closes around 7:30. Yeah, that's right. And took my profit on a decent sized position up at 12:45. So once again, coming in to a tick of the support moving through. And then the 60-minute trade continued up to the 1260 COP resistance, which was also forming part of the daily agreement. So I got out of the 60-minute position over here. It blasted through the resistance, and once you see this happen, and Joe will actually discuss that, it gives you a good opportunity usually to get back into the position. So we had a good resistance, and gold just moving right through that, very, very strong. So once it started to do that, I just re-entered my bid around this blue zone. I think it was around 1270 on the number to re-enter the long position. Gold actually went up all the way to the OP at 1316. Now remember, if you look at this chart, we knew about 1316 while the price was going up. I knew that's going to be resistance. The market came up to the 1316 before starting to pull back into the blue zone. It got oversold and Brexit happened. Boom, in a profit almost immediately. And I actually closed out this gold position just around 1360, around this level this past week. So it just shows you the revisit of the strong resistance also acts as support. So this is getting very advanced. I'll leave that to Joe for his discussion later on. So I'm going to show some E-mini examples as well, since I know a lot of you traders probably look at the E-mini. Once again, same principle. We have a daily sell. The market's reacting on the sell. That's good. That's what I want to see. Look at your hourly to try and get short the market. So once the hourly guys start to buy, I'm looking for a spot to sell. The spot to sell, our confluence agreement zone once again. So why didn't I take the OP agreement at this stage? It's exactly where the hourly guys are buying. I don't want to be buying exactly where a lot of traders are going to be. I mean, I don't want to be selling exactly where a lot of traders are buying. So I would rather be looking to sell the higher level. Unless I want to be very aggressive. In this case, it's just a trend trade. I don't see thrust. I'm not too aggressive. Looking at the 73 to 76 zone, the market came up into that area. It consolidated all the time there and did a wash and rinse. This is what we call a wash and rinse, and I'll show that on the 5-minute as well, to clear out some of the sell stops. I mean the buy stops. Some of the people that traders that sold this zone, just ticking up to the confluence, the higher confluence zone at 79 before starting to turn down. Calculated the ABC down, OP at 2045. We actually had a little bit of daily support at 52 as well, I remember. So I was out around 52, but expecting the market actually to test down into this OP, which it did. So once again, applying the same concept. Daily down, so looking to sell once the 60 has turned up, and getting out once the 60 turns down. It takes you into your profit. Now I'm going to zoom in to this consolidation and what happened over there. There you remember the resistance 73 to 76, 75, 76. So I've drawn that in. There you can see the 75, 76 zone. The market coming up to that level on the 5-minute. It's been consolidating the whole day. This was the FOMC decision on the Wednesday. And when the FOMC decision came out, that's when we had the wash and rinse. Once I saw this wash and rinse, I just knew there's a good chance that, remember, I'm expecting the daily traders to push the market down from this level. So that's my context. I'm actually already short. Now I see this. That's confirming my view. I want to sell some more. So I calculate the F3, sell it a tick below that. I got a fill. The market went down to a small COP before it started consolidating. Now I didn't panic yet because my big confluence zone still holding, and I actually wanted to see the market take some decent stops down to the bottom, and we had the gap to fill as well. I was very interested in this buy signal to see how the market reacts. So once we got the buy signal on the 5, you can see how it's just being stepped on. It's going nowhere. And once we had the next sell, I really wanted to see the market move. And that's exactly what happened. So it went and closed the gap right to the OP, and there. I quickly want to show this as well. Did you see how this node automatically changed? So the software detects as the market makes a new low on this 5-minute or a 1-minute, any time frame, it will move down as the market go down. So you don't have to adjust your fib nodes. The software does it for you. So you can just see where the resistance is as the market develops without having to adjust the fib nodes the whole time. This enables us to trade 1-minute charts. There's no way you can trade a 1-minute chart on Fibonacci without these nodes adjusting automatically. Everybody still okay? Everybody hearing me? I see someone says there's no sound.
I can hear you, Peter.
Okay, good. I'm gonna carry on. So that was once again the same concept. Looking to sell after the market confirmed my view, watching the buy and sell signals, watching the resistance, and looking for a good target down with the market closing the gap. That's a
Okay,
5-minute
Peter,
S&P trade.
Peter, one thing that I know is going to confuse people because I've been teaching so long is you talk about selling buy signals. And
Yeah.
I think we need to emphasize, excuse me, that we've got a context here. And let's say the context is on a daily chart. If you want to be a buyer or a seller, you're going to have somebody the wrong way in order to get a fill. So when you're talking, as you did there about the buy signal, you're selling against a buy signal because your higher time frame context is with you.
Yeah, that's right. So looking to, and that's what we're talking about, fading. So going against the buy signal. We're actually using the buy signal to position ourselves against a good resistance node, our fib nodes, to get short, expecting a move down on the next sell signal, like this one we had over here. Looking at another Euro stock example, I think we're going to bore you guys with examples. Look at this 30-minute sell. I mean, I don't know the market's going to react like this. So now I know there's some good weakness in this market, a good trend, and I want to get on. So looking once again to sell the market once a 5-minute can turn up. So we had a 30-minute sell. I'm waiting for my 5-minute buy to sell the market, but not exactly where it's crossing, right where my nodes are telling me that. So we've got a resistance confluence agreement between 39 and 41. Wait for the market to get up to that level. I always give it a tick just to ensure a fill. Got the fill, calculate my ABC expansion down, wait for the next sell to take me down into my exit. Once again, the stop, I usually place my disaster stop above the XOP, and if I have a strong node like this, I would be very concerned if the market broke through that and would be looking for a way to get out. So I might be risking a lot on a disaster stop, but actually getting out on just a tick or two loss if the market goes against me. Once you have a good setup like this, the market usually works. With the 30 minutes showing such good follow through, and that's what we call strong dynamic pressure. It's a concept we use. Chances are quite slim that a resistance like this won't give you another sell-off down into the next support. So that's the Euro stock. More Euro stocks. This was last week. I was trading or sitting neutral, watching as non-farm came out once again. The non-farm actually blasted us right through this agreement zone, so 28.21 to 28.17. The market blasted right through that zone, so I was looking to buy the revisit where the node that was resistance actually becomes support and expecting a move down, up into the XOP. So I got a fill around 28.19, I think was my fill if I remember correctly. Out at 62 the next day, that was on Monday, and a nice little trade. So that's just a swing trade. I carried the position over the weekend. The stop on this one, we had some focus reaction points down, but actually this zone between, I think 10 was the primary F3 and 21 was the zone. So I had a very tight stop, and the market never really pushed through this level, didn't get below 10, and my trade really wasn't in much danger. And then I saw someone ask about oil. I had to put in this oil trade that we did yesterday, or that I did yesterday. Oil sitting on a daily support. Now, once again, this shows you need to know what the higher time frame levels are looking like. So oil sitting on a daily support, and I was expecting a bounce from this level. So I was looking to trade this bounce, and the overnights was up quite a bit, so the market gapped higher on the 30-minute. Obviously the 30-minute trend is up due to that, so I was expecting to trade this or to see the market bounce from that daily support. So with the 30 up, I was looking to once again get long the market. So wait for a 5-minute sell to take you down to your level to try and buy the market. Not you. Sometimes you don't get a setup like this, or you don't get a fill. The key is to wait for these setups and be patient for them to come down to your level, give you a fill, and play out. Well, I had a entry a few ticks above the 64 zone. I got my fill. The market actually went through this level quite a bit. On the overnights, I had another support at 54. So I wasn't too concerned with the market showing two support areas. You can't always pick the exact low. And I was more interested to see how the market's going to react on the next buy. So as long as we remained above the XOP, which is my stop, I was happy to hang on to the position and see how the market reacts on the next 5-minute buy. I was targeting the COP in this case. A couple of reasons for that. It's almost $1 move in oil. I mean, that's a big move for oil. So even though the COP is the contracted objective point, $1 move in oil is still big for a day trade. We had good follow through on the 5-minute, exactly what I wanted to see. And then there was two other reasons why I wanted to get out at the COP. Remember, I was only trading the bounce on oil, so the daily trend was still down, and we were a little bit overbought on the hourly. So good reason to take the COP, and if I look at the oil price now, I think I made the right decision. So a nice little profit on the oil trade, and that was only yesterday. So that's it. That's my trades. I'm going to hand it over to Joe. He's got one or two more good trades to show you, and then we'll show you the special as well as the tools, and we'll take questions.
Yeah, the thing is, I can see from the questions that people want to get into details, and they want to cover this market or that market. You know, it's completely impossible. I mean, let's just back up a second here. This is a trading methodology that is a life's work. If you're going to learn it, it's going to take time. If you start to learn it, you will immediately benefit. You will immediately benefit because you're going to have numbers ahead of time that are extremely accurate where the market is going to support and resist. But, you know, this presentation is simply not for teaching you how to do this or how to trade this tomorrow. It's completely impossible, and you're just going to get into trouble if you try it. We will show you a way forward if you want to do that. What you can get from this presentation is what is it that leading indicators are, how do you use them, how do professionals use these leading indicators in order to make money safely, reasonably safely. And if all that looks good to you, then you can pursue it. Now, I'm going to show you two trades that I've made. This first example is what I did when I was in Poland about 2 weeks ago, giving a seminar, an advanced private seminar to a group of Polish people. Great place, great people. We had a wonderful time, and this is just showing you one of the trades that we made. I made 6 trades over 2 days. I had one loser. It was a 1-tick loss. The other 5 had an average gain of about 15 to 20 ticks, and I'll show you here what one of those trades were like. Very simply, this is a 60-minute chart, and we have a confluence area. The confluence area is formed by the focus number, which is, let's see if I can get a red dot here. I don't know what I'm doing wrong, Peter, but I don't have a red dot.
I'll show it. There's the focus.
Oh, now I have
there's
two
your dot.
dots.
Okay.
Okay, so we got the focus number up here. We have a reaction here. We have a reaction here. This gives us 4 fib nodes and 1 confluence zone. As the market comes down to the confluence zone, this is where I know I want to be a buyer. So in order to get a fill, I'm going to drop that down to a lower time frame. And this is the lower time frame. This is the 5-minute chart. These 2 lines represent the numbers for the confluence zone. There's the top part of the confluence zone. There's the bottom part. One of these is a 0.382. The other one is a 0.618. The market comes down. My fill came in at 2107.50. That's where I was filled. I immediately calculated an A, B, C, and put my exit up here at the COP, very important. I put it in ahead of time. And as the next chart shows you, I hope it shows you, that COP was hit and I was out. Now, what I did was, since the confluence zone was still alive and viable, I waited for the low to be taken out. We had a situation that we call a wash and rinse occur. Now, I don't have the time to explain all that, but this is a wash and rinse situation. Got long again, and once again, here we go. A, B, C. That gives us the COP right here. There were stops above the market, and I have a choice. I can take the COP out or the OP out. But because of the stops that are above the market, my decision would be to take that, that I would take the higher objective point and put my exit for that order up here at the OP. And as you can see, that the market went right up to the OP. I mean, this isn't rocket science. Once you understand what you're trying to do here, you're trying to establish a support zone. You enter by dropping your time frame, you get that support zone, and then immediately, as soon as you get it, you put in an objective. Well, you can't put in an objective until you get a C point. In this case, the C point is here. But what you've got to realize is, you know now where to take your profit. You can take your profit at the COP, or you can take your profit at the OP. You're not guessing. You're not waiting for some trend to go down, lose half of the money that you booked before you get out of the trade. You have an objective point in there ahead of time. Now, one of you or two of you out there are saying, well, geez, Joe, what if the market goes to infinity? I would have made $1 billion. Well, guess what? You're not going to be there. You use this approach, you're going to have an objective point order in there ahead of time, and you're going to get out at that objective point. And if you think about it, how many times has the market gone to infinity? However, it goes to the COP and the OP all the time. All right, let's see if I can. All right, this trade, this is, I think, a really good example, and it's probably for the more advanced among you. And this is the Brexit situation. And I've got to tell you how I managed to screw up something that should have made me a lot of money. On the day of the Brexit decision, I manage a variety of accounts, mine, and some of them are substantial stock accounts. I mean, I trade futures in them too, but they're substantial longer-term accounts. Then I have short-term accounts as well. Anyway, I just did great here on my short-term accounts on the way down. And this is a daily chart. But during the day, we had a lot of reactions back. Even though it was the Brexit, and even though things were not looking good for the world, there were reactions back on a 5-minute chart, on a 3-minute chart, on a 20-minute chart, and there were opportunities to get short. And remember, we know where to get short ahead of time. All right, so I'm doing terrific, and it was a hard day. I did a lot of trading. I don't know, I probably got 15 or 10 trades going that day. And we come down here, and I'm in a different location now. I'm in Massachusetts. I'm not in my office in Bangkok. So I apparently don't have the focus I should have. And I'm thinking, what a great trader I am, and I wrap up the day and go downstairs and have supper, and I realized I left a couple of orders in the market. Well, these orders were not stop orders. They were or better orders lower, and the market hit them, and they hit them right about here. Okay, so I mean, there's no way in God's earth I wanted to go long this market here. There was no DiNapoli support here except on a 5-minute chart, and now when the market's closed, I don't even know I'm filled. I'm long a substantial amount given the volatility. And by the time I realized where I was, I'm way down here. Now, I'm way down here, I have to make a decision. Do I get out here, or do I stay with this trade? I couldn't add more, because if I was adding more, I'd be averaging a loss, and that's not something I do. I can scale in, but I can't average a loss, and we don't have time to discuss the difference. However, I had done all of my numbers, and I knew that there was massive DiNapoli support down at this point. or very close to this point. Therefore, it was absolutely foolish for me, even though I was positioned incorrectly because of an error, it was absolutely ridiculous for me to get out of this thing because that's where I would be buying it. So I left the position on, and the next day we had a gap up, we started to move higher, and I got out of my short-term accounts at a small loss. I wasn't going to fool with it. I got out of that at a small loss. So I made lots of money on the way down, got out at a small loss on the way back. Now let's talk about what happened after that. If you calculate an A, B, C, we have a COP, OP, and an XOP. Now, this market, given the thrust down, should have stopped at the point 382 and either the COP or the OP. There's no way we should come up to the XOP. However, sometimes markets behave in ways that we don't understand. And when that happens, we can take a hit, or we can go back in history and we can see if we've learned something in the past that's going to help us. And this is quite important. I want to tell you about this. But I want you to notice this number right here. This last digits are 550, and the digits here is 6675. The 675, this is the 0.618 retracement. So we have agreement here at the XOP and the 0.618 retracement. And this is typically a wonderful place to be a seller. So I am unhedged in my large stock accounts. And I figure, hey, you know, I'm not going to fool with this thing. I'm going to throw some hedges on here. And I did. I hedged fairly heavily right at this level. Now, let's go on and see what happened. Page 99, Chapter 6 of Trading with the Napoli Levels. This is published in late 1998. We have a formation and we have a signal called the railroad track. Now this railroad track, I want you to take a look at this and remember that the book was done in 1998. We have a picture, and when you get this picture, what happens is you want to buy a shallow retracement. So I knew that railroad tracks existed, and since I wrote the book, and since, look at this. I mean, if that isn't perfect, and it was even more picture perfect in the Dow. I mean, this thing was I mean, this is a railroad track. This is the signal that I wrote about in 1998. We've been getting more of them, by the way, since we have all this algorithmic trading going on. Something that's happened in the last 4 years, starting about 4 years ago, maybe 5 years ago, is that revisited areas have become extremely important. In other words, we've gone through the 0.618, okay? Now, if we can revisit back to the 0.618, it'll provide tremendous support. This wasn't the case 10, 15, 18, 20 years ago. A revisited node was not important, but it is incredibly important today. There's reasons for it, but I'm not going to get into that kind of detail because we don't have the time. Now, let's take a look at what happened. Here is your revisit point. Remember, I'm hedged. I'm seriously hedged. And obviously, my hedges are in significant losses by the time we're up here. Notice that we're at the overbought point on the oscillator predictor. I mean, all these tools come in together so that they give you a context and a framework where you can do your trades. We're overbought on the oscillator predictor. I'm not going to get panicked out and close my hedges. What I'm going to do is I'm going to wait for the retracement back toward that revisited node. Now, if you go back to the picture in the book, buy a shallow retracement. Right? I didn't know about Brexit in 1998, right? However, this is what's happening in 2016, and I talked about it in 1998 in the book. And here is the picture. Here's your ABC. There is your XOP resistance, which now is a revisited XOP. If you do focus, reaction, 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 you get a confluence number right here at the almost exact same number. And on top of that, you've got a 0.618 revisited node right here. I mean, nothing is going to be stronger than that. So I cleared all of my hedges right down here, almost at break even. I was still in a little bit of a loss on my hedges, and I went heavily long. And you guys know the story after that. we have A, B, C. I believe we came up, yeah, because I was actually selling this point today. Right, all right, so we came up here to the COP, and the typical target for a railroad track is up here at the OP, and that would be 2189. This is a complicated trade. It shows you how you can screw up. I screwed up badly. I left orders in the market that shouldn't have been left in here. I ended up hedging a large portfolio in the wrong place, okay, for good reasons, but in the wrong place, and I made money. And the only damn reason I made money is because of these tools. I'll tell you that right now, because if I didn't know there was massive support down here, I'd have gotten out of that error trade, all right? And I wouldn't have got out on this way back up, and there were thousands and thousands and thousands of dollars involved on this way back up. If I didn't have these numbers, I wouldn't know where the resistance was to get back in this railroad track trade. And yeah, we're up here now, and there's